QuickBooks Pro Desktop 2021. Purchase and finance equipment. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view drop-down, selecting the open windows list. We're going to be now purchasing equipment. We're going to be purchasing equipment on account. To consider that transaction, let's open up our financial statements, our balance sheet, by going to the reports drop-down, company and financial, and on down to the balance sheet standard. Adjusting the dates up top in the customized reports to 01/01/21 to 12/31/21, January through December 2021, and OK. So we're going to be purchasing equipment. We're going to be purchasing equipment by financing the entire purchase of that equipment. Now let's think about just the purchase of equipment quickly here. If we purchase equipment, then we're purchasing something large like a forklift or a car or something like that we're going to use for multiple periods in the future. Let's first consider a situation as if we were going to purchase it with cash. Let's just imagine we're going to purchase like a $15,000 car with cash. If that was the case, we would decrease the cash and we would put the other side not to an expense, even if we're using a cash method typically. In other words, if we were using a pure cash method, we might do that. But normally, even if we're using a cash method, people will deviate from the cash method to an accrual method for that type of transaction because that purchase will be impacting multiple periods in the future. And therefore, instead of putting it on the books as an expense, we'll put it on the books as an asset. Now, if we put it on the books at an expense, if we did use the cash method and just put it on the books as an expense in, say, the month of February, the problem is that then it would look like we had a bad month of February because we have this big thing that we purchased that's not just for that month, it's for many months in the future. So when I compare February to March, February is going to look bad, and it's not February's fault. That just happened to be when we purchased this thing that's really an investment that's going to impact multiple periods in the future. So to have that comparison, we typically put it on the books as an asset, then depreciate it. Now, this will be similar for taxes as well. Even if you're on tax basis method and you're using kind of a cash method, you might have accelerated depreciation for taxes and whatnot, but the general concept is the same. We have to record it basically as an asset and then record the depreciation related to it. So now we're going to do that, but now we're not going to be paying cash. We're going to be financing it. So we're still going to be increasing basically a fixed asset type of account, but we're going to be increasing a loan to do so. Now, if I go back to the forms over here, note that there's no form that's really set up for this type of transaction. So we got to go through the list of what thing are we going to use in order to do the data input. And I'll go through my list of priorities of top to bottom in terms of how to think about what to use to enter it. First, can I use one of these forms here to enter it? No, not generally, because this isn't a transaction that happens all the time. We don't always purchase large pieces of equipment. Therefore, there's not a fixed form for us to do so. So you might say, well, can't I use a bill to do it? Because basically I'm purchasing something on account. A bill would make it so we could increase the asset account and the other side would go to a liability account, but it wouldn't be a liability like a loan. It would be the accounts payable. And accounts payable generally is not something that charges interest in it. So we don't really want it in accounts payable. We want it in a loan, and therefore we don't typically use the bill. So if I can't use one of these standard forms, then I'm going to say, well, is cash affected? Because if cash is affected, I like using the cash register. But in this case, if we finance the entire thing, cash is not affected, so can't use the cash register for it. So then I would think, okay, well then I can either use a journal entry if I'm comfortable with journal entries, or if I could use some other register, which is what I'll default to here. So we can use some other register. And if there's only 2 accounts affected, or if there's a fairly small number of accounts affected, and one of them is a balance sheet account that we can use, then we can use a register and use it in a similar fashion as we have with cash. Or we can use a journal entry. And if the transaction is too complex, then we would go to a journal entry. We would have to use basically a debit and credit type of format to do that. So we'll take a look at both the journal entry and the use of the register as we enter this. Let's go back to the balance sheet. Now, when we do this, we're going to be increasing a fixed asset, which could be called property, plants, and equipment, PP&E, depreciable assets. We already have the category here for furniture and equipment. Let's make an adjustment to that now. I'm going to say, okay, all this stuff before was furniture, let's say, and let's keep this in furniture, and then we'll create a new account down here for the new item that we're going to purchase, which we're going to say is in the equipment category. If we do that, then we have to think about, do we want one accumulated depreciation account then for all of our fixed assets, or do we want to break this out? I'm going to go ahead and break it out and have two accumulated depreciation accounts for each category. Now, in practice, what you want to do, most likely, if you're a small to mid-sized business, is probably tie out to the same kind of categories that would be on your tax return. Like your tax preparer would be entering this into your tax return. They'd have to record depreciation. They'd probably be grouping your categories in a similar fashion for taxes, and you might want to mirror that on your books, because that makes the adjusting entries as easy as possible. And again, the recording of accumulated depreciation to depreciate this information, oftentimes small businesses and mid-sized businesses will be dependent, even will be dependent on the tax software for the company, because they have to enter all that detail in anyway. So they can help you to then print depreciation schedules, whether they be tax depreciation schedules or book depreciation schedules for the year-end entry data input. And if your categorizations line up to their categorizations, then that's going to make it as streamlined as you can do so. Also note that as we enter our equipment into the books, we want to make sure that we have that detailed information so that we can then provide it to the tax professional at the end of the year, because no matter what we do on our side, they're going to have to do whatever they need to do for tax depreciation, which is different than book depreciation. And to do that, they're going to need whatever purchases happened during the year. Obviously, fixed assets, we don't make a whole lot of purchases, so it should be fairly easy for us to say, hey, these are the big things that we purchased throughout the year. Now, the other side, we're going to finance the entire thing. So notice down here, we have a loan payable. So we have the loan payable. I'm going to put it into another account down here, and you have some options with the loans down here. You might put them all into one loan account if you have multiple loans outstanding. And that way it's a little bit cleaner on your financial statements. And when you give it to somebody else, then you have it nice and grouped the way they probably would prefer to see it, rather than a bunch of loans broken out. But from data input standpoint, it's kind of nice to have different loans on the books for each loan that you have so that you can track them. So I'm going to do that. I'm going to break it out and have a different loan down here for this next financing loan that we're going to have for the financing of the equipment, because I think that's easier to basically look at. And then we can think about how we can kind of group those two things together under one subcategory, and we'll take a look at subcategories to do that. Also note that you might want to be breaking out between short-term and long-term loans. This one, you can do that by basically, I would put it all into one category, which I'm going to say short-term at this case, and then break it out periodically, doing adjusting entries at the end of the time period with adjusting entries. We'll see that when we go to the adjusting entry process. Okay, so let's do this. We're gonna go to the home page. A couple ways you can do this data entry. If you want to do a journal entry, if you're comfortable with debits and credits, you can go down to the company and you can enter a journal entry. So you can make a journal entry. But I'm going to go to the registers. So I'm going to go to the lists and go to the chart of accounts. So we're going to go into the chart of accounts, and either of these two accounts are affected, but I want to make two new accounts really here. I need to make a new loan account for the new loan that we're going to have, and I want to make a different account for the property, plants, and equipment. So here's the property, plants, and equipment. I'm saying, hey, look, I would like to make this just the furniture and break out the equipment to line up, let's say, to our taxes a little bit easier. So how could I do that? I'm just going to adjust the name here. I'm going to go to the account Rise Up. I'm going to edit the account. And then I'm going to say, I'm going to remove the equipment and just call this furniture. And then I'll just remove the description down here because it's fairly self-explanatory then. So furniture. And then I'm going to make another one, which is going to be the equipment. So I'm going to make another fixed asset called equipment. So I'm going to say new. And I'm going to make another account. It's going to be a fixed asset type of account. And I'm going to say continue, and I'm going to call it equipment. So equipment. So that's going to be our equipment account. It's a fixed asset type of account. So I'm going to say save. So there we have that. Now we're not going to be recording the accumulated depreciation yet, but we will do so in the future once we do the adjusting entry. So we may as well put the complement account of accumulated depreciation related to this equipment as well. Now note again, you could combine all accumulated depreciation into one accumulated depreciation account, but if you get a schedule from like the tax preparer, they will typically have different accumulated depreciation accounts. So you may want to break them out. It might be easier, either way, there's pros and cons to it. I'm going to break them out here. I'm going to say, okay, I want another account now. I'm going to say a new account again. It's also going to be a fixed asset type of account. And we're going to say continue. It's going to be accumulated depreciation for the equipment. So equipment had to be abbreviated. Notice you could shorten this if you want to have some type of abbreviation, like to fit your whole. So I sometimes call it ACC Depre because they only let me have so many characters in here, and then equipment. And so I'm going to say save and close. And then this one up here, notice it's our generic accumulated depreciation account. I need to edit it now. So I'm going to edit that one. I'm going to go to edit, and let's say we'll edit that one. And then I'm going to say this is ACC Depre, and this is for the furniture. And I'm going to say furniture. And then I'm going to remove the description down here and say OK. So now we've got those two items set up. Now we also have the loan payable down here. So the loan payable, that's our the large loan that we have out. So we might want to adjust the new loan. I want to put the new loan in a separate account here. Now once we break these out, we might want some kind of differentiation factor, such as the last 4 digits of the loan number or something like that to tell us what the loan is. And then we can group them together for demonstration purposes. So let's do that. I'm going to say new, and I'm going to say a new account again. This is going to be a loan, so I'm going to make it a loan and continue. And this is going to be, I'm going to call it loan payable, but then I'm going to put it into for the equipment. Now again, you might want to say who the loan is to, or possibly like the last 4 digits of the loan number. Rather than maybe equipment might be a little bit easier to work with, so that when you're paying this off, you know exactly where to go, which account to hit for it. So I'm going to say save. So there we have that. So now we can make our adjustment. Now I can either go into the loan is going to go up, or I can go into our new equipment account. So I'm going to go into the equipment because I think it's easier to use the register for the thing that is increasing. So we're going to use a register kind of like the cash register, but for equipment. And we're just going to say the equipment is either increasing or decreasing, just like cash increases or decreases. So I'm going to double click on this. And now we're in a register. So I'm going to say within the register, I'm going to say this is 022821. And we're going to say that we're going to purchase this from, let's say, Office Depot again. And it's going to be an increase. So we want to be on the increase side because we're in the equipment account, 5,000. And then it's going to be going into the loan payable. So I want to take it to the loan payable that we just set up. So we want to make the loan payable for the equipment. So there it is. And then we can put a memo, purchase of equipment. And you probably want more description than the purchase of the equipment there that you can have. So I'm going to say OK. So there it is, transacted. Now if I double click on this little item here, it'll show us the journal entry, which we also could have entered. If you're comfortable with journal entries, you probably were saying, why don't I just enter a journal entry? You can there. That would be the place to do it. So it would be a debit to the equipment and a credit to the loan payable. And that'll be the same thing. We're basically doing a journal entry. We're just doing it with a register format, which has some problem. Like the journal entry works better if you have a long account, then you kind of have to do debits and credits. But if there's only 2 accounts that are affected, the register does basically the same thing, and that'll work. So I'm going to say close this out. Let's close this out. Let's go to the balance sheet now and see what happened. So if I go to the balance sheet, now we have on the equipment side of things, we have this broken out now. Now we have equipment, we have furniture. We have the accumulated depreciation related to the furniture. Notice it's kind of out of order here. You would like to see it basically equipment, accumulated depreciation for the equipment, furniture, accumulated depreciation for the furniture. You can't do that without account numbers because within this subcategory, it's going to be grouped by alphabetical order. So we might talk about account numbers later, but that's going to be, kind of the default of not using account numbers. But if you don't use the account numbers properly, they can cause problems. So we're going to keep going forward without them. Notice, of course, the equipment accumulated depreciation account did not appear now because there's nothing in it yet. There will be when we do the adjusting entries at the end of the time period. So then if we go into the equipment account here, we see our amount. If I go into that item, we go back to our register. If I double click on the journal entry, then you'll see the journal entry in terms of debits and credits. So I'm going to close this back out, Notice it's the journal entry type. That's the form. Even though we entered into the register, there's no form related to it. Therefore, it's a journal entry type. The other side's in the loan payable down here. So if I go down to the loan payable, and so there it is for the second loan that we have, double clicking on the loan payable. So there's going to be the loan payable. And so I'm going to close that back out. So now just from a look standpoint, if I was to present our financial statements to someone else, I might just want to collapse the fixed assets. So I could just collapse these, and then I can see it nice and cleanly and say, look, there's my book value, my net fixed assets. Or you might want to create subcategories here, and by creating subcategories, you can basically that's another way you can adjust or account for this basically ordering problem that we have, and you can make a subcategory for the furniture and the accumulated depreciation related to it, the equipment and the accumulated depreciation related to it, and then you can kind of close them up in a similar fashion using something like this. Same thing down here with the loan. We have 2 loans on the books now. That's great for us, but if we want to present it, we might want to present it with those 2 loans kind of collapsed. So we can have more flexibility to do something like that with that sub accounts. So next time we'll take a look at that. We'll make sub accounts for these 2 loans, and so we'll make a parent account and then put these 2 loan accounts within it, and then we'll do the same thing, and we'll work with these fixed assets and think about what we can do with sub accounts related to those items. You can apply similar concepts to other areas. Some people really like the sub accounts. You can kind of go overboard, or you can apply the sub accounts in ways that may not be as productive. But if you apply sub accounts correctly, or in a way that's functionable, then they can be a useful tool to have. So next time we'll take a look at sub accounts for these 2 items. And again, you can think about where you might want to put sub accounts in other areas as well. You might group, say, for example, expense accounts using sub accounts as well to kind of break out more detail when you need it, and then collapse that detail when you want to display that information. So this is where we stand at this point in time in terms of the balance sheet. No effect on the income statement. I'm going to go ahead and open up the trial balance so you can check your numbers there if you so choose. Go into the reports drop down, on down to the accounting and taxes trial balance, changing the dates up top from 01/01/21 to 12/31/21. Here's what we have in terms of the trial balance.